Welcome back to Iron Financial. This is the place where we forge stronger portfolios by cutting through all the market noise. And today, we are putting on the hard hats, we're grabbing the blueprints, and we are going to inspect the structural integrity of Newsmax, ticker NMAX. They just dropped their Q4 and full year 2025 earnings. And folks, the market's reaction is just a textbook case of confusion. The numbers are telling two completely different stories, and it's our job to figure out which one is the truth. Okay, let's get into it.
And here it is. This is the central puzzle we have to solve today. So right after the closing bell, the earnings release hits the wire. And what happens? The stock immediately rips higher, shoots up 11% in after-hours trading. Now, the algorithms, the headline readers, they see that and they think, all right, this must be a beat, time to pile in. But then you actually crack open the SEC filing, you dig into the numbers, and you see this number, a staggering $99.5 million net loss for the entire year. So which is it? Is this a healthy company with a surge of investor confidence, or is it a bleeding company that just saw a momentary, totally irrational pop?
This right here is a classic retail trap. It's what happens. You see the green, you see the headline, and you just dive in headfirst without looking. But the smart money, you know what they're doing? They're looking at that huge loss, and they're asking the real question. Are we looking at a skyscraper in the making, or is this building already condemned? Is this genuine strength we're seeing? Or is it just a dead cat bounce on what could be a house of cards? This is exactly the kind of report where people lose their shirts chasing headlines instead of actually reading the fine print.
Exactly. And to figure that out, we have to start where any structural inspection begins. You start with the foundation. We need to examine the steel beams holding this company up, and that is its revenue engine. So for a minute, we're just going to set aside the whole profitability issue and focus completely on the top line. Is the company generating significant growing sales? You know, if that revenue structure is strong, they might just have the materials and, more importantly, the time to fix the rest of the build. But if it's weak, well, the whole thing might be a teardown. So the first piece of heavy-duty steel we see is this number, $189.3 million in full-year revenue. Let's be really clear here. This is not some small-time operation working out of a garage. That is a significant, heavy top-line figure. It tells us right away they have a real product, they have a real audience, and they are generating substantial cash flow from their operations. This is the bedrock you can build on.
Yeah, but a big number by itself is a vanity metric. What really matters is the trend. Is that number growing, or is it just rusting away? I mean, $190 million sounds great, but if it was $250 million last year, then it's a total disaster. Context is everything here.
Oh, it's growing, and it's growing impressively. Now, what's really fascinating about this chart is the story it tells. We're looking at 10.7% year-over-year revenue growth. So they went from $171 million in 2024 to over $189 million in 2025. Now, you have to remember the environment they're operating in. 2025 was a non-election year. For news media companies, that's almost always a down cycle. The political drama fades out, viewership dips, and advertising demand gets soft. Most of the legacy media companies actually see their revenue shrink in an off year. But as CEO Chris Reddy pointed out on the earnings call, Newsmax delivered strong growth. This isn't just growth. This is growth while sailing directly into a headwind. When the rest of your industry is struggling and you're powering ahead, that's a sign of some real structural strength.
So let's drill down into the architecture of that growth, because this table is absolutely critical. It shows us exactly what's working and what isn't. Just look at the top line on this table. Total broadcasting. That's where the muscle is. It's up a massive 17.3%. That is the core of their business, and it is firing on all cylinders. Advertising revenue is up almost 17%, and that's driven by higher ratings and better pricing. But the crucial point, the real pillar of strength here, is the line right below it. Affiliate fees, up nearly 15%. This is the good stuff. This is high-margin, recurring revenue they get from cable and satellite providers just for carrying their channel. It's contractual, it's predictable, and it's incredibly valuable. That is a foundation you can build a skyscraper on.
Okay. The broadcasting side looks solid. I will give you that. That affiliate fee growth is impressive. But my eyes are immediately drawn to that big, ugly red number on this slide. Total digital revenue is down almost 11%. And if you look closer at digital advertising, it's in an absolute free fall, down 19%. I mean, in this day and age, if your digital business is shrinking that dramatically, isn't your entire future business model at risk? That looks less like a steel beam and more like rotting wood that's supposed to be holding up the structure.
It's a completely valid concern, and trust me, we are going to get to the cracks in this structure. But before we do, look at the rest of the foundation, the balance sheet. They are sitting on a fortress, over $131 million in cash and short-term investments. And here's the real kicker: zero debt, absolutely none. This gives them immense financial flexibility.
Look at that current ratio of 2.74. That simply means they have $2.74 in current assets for every $1 of current liabilities. It's a key measure of short-term financial health, and really anything over 2 is considered very strong. They have the capital to fix the problems, to invest in that digital segment, to weather any storm, and to finish this build without ever having to go to the banks.
Hold on a second. A fortress balance sheet is great, but if the market really believed it was a fortress, the stock wouldn't be down 93% in 1 year. 93%. That is not a dip, that's a crater. That is the market screaming at the top of its lungs that something is fundamentally broken here. All the cash in the world doesn't matter if you're just lighting it on fire every single quarter. That stock performance is the ultimate vote of no confidence from investors. It tells me the market doesn't believe the story management is selling, no matter how much cash they have in the bank.
And that brings us to the real problem, the part of the inspection the bulls don't want you to see. A beautiful revenue facade is just a movie set if the floors are missing and the basement is completely flooded with red ink. So let's talk about the deep structural cracks in this company's profitability. Because right now, this apparently strong foundation is sinking under the weight of its own catastrophic losses. Here it is, the number that negates all the optimism about revenue growth, a net loss of $99.5 million. Let's really just process that for a second. This company generated $189 million in sales and somehow managed to lose nearly $100 million doing it. That means for every single dollar that came in the front door, about $1.53 went out the back. How is that even possible? Your sales are up over 10%, which should create operating leverage, but instead, your losses are just exploding. It means your cost structure is completely, totally out of control. This isn't a business, it's a cash bomb fire. And this isn't some new problem that they're just now fixing. This brilliantly illustrates that the bleeding is accelerating. The net loss widened by 37.8% in a single year, from a $72 million loss to a nearly $100 million loss. This is not a company that's growing into profitability. It's a company whose losses are growing faster than its revenue. This indicates a severe and worsening structural issue. The CFO tried to paper over this with some talk about a one-time legal settlement, but come on, do the math. Even if you completely erase that $79 million, they're still deep in the red. It's not a one-time problem, it's a systemic failure of the business model to generate profit. And hey, don't just take my word for it. This is not just my opinion. This is from the company's own earnings release, where they cite Investing Pros Analysis. An independent third-party firm ran the numbers, they stress-tested the models, and their final conclusion is that Newsmax has a weak financial health score. When the outside inspectors are putting a bright red warning label on the building, you better pay very close attention. This is an objective, data-driven assessment saying that the financial structure has critical flaws. And let's come back to that rotting wood I mentioned. The digital decay. It's not just one bad number, it's the entire segment. Advertising, down 19%. Subscriptions, down 13%. Overall, down almost 11%. Now, management blames a challenging prior year election comparison, but that just sounds like an excuse. The future of all media is digital. It's streaming, it's online, it's mobile. If you are not growing your digital presence in this economy, you are not building for the future. You are managing a decline. You are actively trying to sell blockbuster video in the age of Netflix. This is not a temporary dip. It is a strategic failure of the highest order. Okay, the bear case is clear and it is powerful. The losses are severe, they're accelerating, and the digital side is a major, major problem. Nobody is disputing that. But for an investor who's looking at a high-risk turnaround, the present is less important than the future. So the question becomes, does management have a credible blueprint to patch these holes and actually finish the construction? Or are they just designing a taller, more expensive failure? Let's examine their plan. First, let's just look at the CEO's own words from the earnings call. This is crucial. He says, and I quote, "We recognize the need to improve our profitability." This is not a management team with their heads buried in the sand, ignoring the reality of the numbers. They are publicly acknowledging the exact problem that the skeptics are hammering on. They know the structure is bleeding cash. They explicitly admit they must manage costs effectively. The first step to solving a problem is admitting you have one, and they have clearly taken that step. So what's their plan to fix it? Here is their four-part blueprint as they laid it out in the call and the release. First, they're pushing hard on international expansion and licensing, and they're aiming to get their content distributed in over 100 countries. Second, they plan to scale up their streaming services, Newsmax 2 and Newsmax Plus. Third, they will continue to push for higher affiliate fees through renegotiations with the cable providers. And fourth, they will continue to invest heavily in content and on-air talent to drive viewership. On paper, it's a pretty standard media growth playbook. A playbook for what? A playbook for spending more money? How does this solve a profitability problem? International expansion is incredibly expensive. Scaling streaming requires massive investment in technology and marketing. And investing in content and talent is just code for spending a ton of money on salaries and production. They just told us their net loss widened by almost 40% because of high costs, and their solution is to spend more money? This does not sound like a blueprint for profitability. It sounds like a blueprint for accelerating the cash burn. How do you patch a hole in your pocket by going on a shopping spree? It makes absolutely no sense. And that is the multi-million-dollar question. And that's why we're here. It's time to step back from the site, weigh all the evidence from our inspection, the heavy steel beams and the deep structural cracks, and deliver the iron verdict. For our viewers, is Newsmax an opportunity to build on, a fixer-upper with good bones? Or is it a financial trap, a demolition job disguised as an investment? Okay, let's put it all on the scales. The bull case rests on a foundation of solid steel. You have double-digit revenue growth in a down year for the entire industry. The core broadcasting business is absolutely booming, and those high-margin recurring affiliate fees are climbing steadily. Most importantly, they have the tools to do the job. $131 million in cash and zero debt. That gives them a massive runway. That cash buys them time to execute their turnaround plan without needing to borrow a dime or dilute shareholders.
But the bear case says that foundation is built on quicksand. The losses aren't just big, they're accelerating at an alarming rate. The digital business, which is supposed to be the future of the company, is actively shrinking. Independent analysis has already flagged their financial health as weak. And that $79 million legal settlement is a reminder that there are massive, unpredictable costs that can just blow up the balance sheet at any time. The cash pile is irrelevant if the furnace you're shoveling it into is getting hotter and hotter. The business model itself appears to be fundamentally broken, and that 11% stock pop was nothing more than a sugar rush before the crash.
So here it is, the iron verdict. Newsmax is not a safe blue-chip investment. It is a high-risk, high-reward construction project. It's a speculative build, plain and simple.
I agree. The top-line revenue structure is solid steel. The growth is real, and that broadcasting segment is strong. But the profitability floor is completely missing. They have not yet proven that they can build a business on that foundation that actually makes money consistently.
Precisely. This is a stock only for investors with a very strong stomach for volatility and a long-time horizon. You have to believe in management's unproven blueprint. You are making a bet that they can use that fortress balance sheet to successfully patch the massive holes in profitability before the cash runs out. It is a race against time, and the clock is ticking. And that brings us to the final question we'll leave you with, and it's the key thing to watch going forward. Management is guiding for accelerated revenue growth next year, forecasting 13% at the midpoint. So the ultimate question is this: will that extra top-line growth finally be enough to pour concrete floor of profitability and turn this project into a finished, valuable asset? Or will the cost associated with that growth, more content, more international expansion, more streaming investment, simply pay for a bigger shovel to dig the hole of losses even deeper? That is the answer the market will be demanding in 2026. Thanks for joining us on RN Financial. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.